Constellation Software is very interesting because there's not really another stock like it on the market. They basically are a serial acquirer. They buy a lot of businesses. And that is not unusual. A lot of businesses rely on growth by acquisition, but Constellation Software is different in this regard. One, their acquisition size. They usually buy very small software businesses. So they own hundreds of businesses. And what's also very unusual is they go the Warren Buffett approach. These software units stay independent. So they buy the software, they do not integrate it that much into the other software suite. It's an independent business. You don't have a lot of merger charges. As you can see, 2014, they had 13 million, not a lot. But when you look at other companies, which do a lot of acquisitions, you will see this number being high always, because they integrate the businesses, then they restructure. It's a mess. That's why I do not like AT&T's acquisitions. They always cost a lot of money to integrate, then they were restructured, and it just cost money for the shareholders. Now, of course, that works with this business model because their business model is not to synergize. And of course, the shares took off recently since 2022. It's on a rampage, and the company is valued currently at a 35 price to free cash flow ratio, which is fairly high. But then you would say, hey, they're constantly growing in the highest 20%. That would be okay for that. Well, yes, but this is what a lot of people mistake with Constellation Software. Let's go into the latest earnings release. We can see revenue grew 20%. Fantastic. But now there's the issue. 2% organic growth. So the businesses they already had has very low growth rates. The 18%, which led to this amazing thing, was the acquisitions. Now, they do not issue shares. Their share count has not moved at all over the last 10 years. And they also don't heavily go into debt. That is not a lot at all. But then you look at the operating cash flow, 1.7 billion. Cash acquisitions, 1.7 billion. Operating cash flow, 1.3 billion. Cash acquisitions, 1.5 billion. Operating cash flow, 1.3 billion. Cash acquisition, 1.2. It kind of hovers around what they earn. They instantly invest into new businesses. And that is not bad. That is not bad at all. If you can invest money at a high return, I would rather you do that than pay it out via share buybacks or dividend. But then I think this company is using all its cash to buy these businesses. If they're buying all these businesses, I want a good return on the already bought businesses. And then I see 2% organic growth. So then I think, why the hell would I pay a multiple of 35 for this company if they're using all the free cash flow to buy new businesses to achieve this revenue growth? And then that revenue growth, which is converted into free cash flow, gets used to buy more businesses. I can understand if organic revenue growth happens, but if you have to invest that free cash flow to grow like this, then that's bad. And it's not of one time. We can go at any point here. Sadly, stock analysis doesn't have that, but we can just go through a few earnings releases. Let's go first quarter of 2023. 2% organic growth. Not a lot. Revenue increased 34%. Let's go second quarter 2022. Negative 2% organic growth. Revenue growth 30%. It is just not a great business, really. Yes, they buy a lot of companies. And yes, that is how they grow their revenue. But what happens when they stop buying? This revenue doesn't grow 20% anymore. It goes 3 to 4%. Let's be realistic. With the growth rates they had right now, 3 to 4%. And then they have like 2 billion in free cash flow. I have a 45 free cash flow multiple for a company that grows 3 to 4% organically. This is a free cash flow multiple that is reserved for the best companies in the world. Visa, which doesn't need to invest all the money to achieve this kind of growth, gets higher growth rates, and all their cash gets paid out to shareholders. I do not think it's a good investment at these prices, but I would say this is a far better company than Constellation Software. Even Apple, they trade at similar multiples, but at least they pay out all their cash. They do not need to acquire all of these companies to grow. And I would say, hey, okay, something is turning around. They bought this business, they bought that business. That is gonna catapult for organic growth, but that is just not happening. This is all their segment. Basically, they separate in a few over-the-top businesses where they separate into different categories. They don't even make sense together. Spa and fitness, construction. It is literally just so it's together. And then it breaks up again. And then all of these hundreds of businesses that are here. This is not even up to date. And then you're telling me, I don't know, this new one business that they bought for a few million is gonna turn this around? It's gonna give you 10% organic revenue growth? No. What happens if the cash flow gets returned to shareholders? Once you cut off, the free cash flow has to be returned to shareholders. What then? No revenue growth. 3%, 4%. And at the same time, 2014, less than a 20 multiple. It's climbing and climbing and climbing and climbing and climbing and climbing for a business that isn't improving. For organic revenue growth is slowing. So let's see what I would pay for Constellation Software. So with all of it in mind, a business which is normally not growing, the only growth that it has is because of all the acquisitions it does. To see if it would make sense at the current prices, I would just have what if the cash flow is paid out to shareholders instead. Basically, 100% of the cash flow is paid out to shareholders, with a little deduction due to taxes. We assume a growth rate of 5% for the next 5 years and 4% after which is pretty high. They have only had 2 to 3% growth, sometimes even negative organic. Let's go with 5%. 18 multiple, not a fast growing business if they don't invest all of their cash. In that case, with dividends, with the end multiple, $1,644 per share. It's currently trading at $3,060. This is a joke. I do not know what the market sees in this company. What if it goes even better? The underlying businesses grow at 10%, then 8%, and we get a 20 multiple on the underlying businesses. 2,400. Still not there. Now what if it goes as it is right now? 3 to 2% organic revenue growth. 15 multiple. And that is fairly high for a company like this in my opinion then. 1,200. This is just not possible. You look at this massively growing free cash flow because it looks like free cash flow, because it is technically free cash flow. But you should treat these cash acquisitions as capital expenditures in my opinion. Because while this company is not spending on capex, their capex is buying other businesses. So in reality, there's basically no free cash flow at any point. That is why this dividend is so low. They cannot afford it. I'm not gonna invest in Constellation Software, not at these prices. I do not have anything against companies which get most of their growth from acquisitions, but I want them priced at that. And what do you think about it? Write down below. Have a good day.